So now we're going to take a look at the trading platform, and we're going to take a look at the stocks that are going to be paying out dividends tomorrow. So basically where the ex-dividend date is tomorrow. Today is April the 21st, and we're going to analyze, because we're using real market data, we're going to take a look at the ones that are paying out dividends tomorrow, April 22nd, and I've already pre-selected CVS Healthcare, and we're going to take a look at their options and see which ones might be at risk of assignment if we're short options, and which ones we should actually exercise if we're long options. So we got CVS Health Corporation, and this is a stock that pays out a dividend of 50 cents, trading currently at $60 and just about 48 cents. And we have the option chain here. And as you can see, we have weekly expirations and also the regular monthly expirations. And the ones that are going to be most at risk are going to be the ones that are the closest to expiration. So these ones with the least days to expirations are going to be the 3, the 10, the 17. And remember, we have to consider extrinsic value. So because extrinsic value depends on the time to expiration, the number of days. So that's why we're going to pick this one, and we're going to take a look at those expirations. So we're going to open up here the expiration with 3 days to go. And we have all the different strikes here. And the at the money is just around the 60.5. That's the at the money. So the ones that are at risk are going to be the calls. So these calls are trading with a certain portion of intrinsic value and extrinsic value because they're in the money. So we're going to focus on the extrinsic value. So the ones where the extrinsic value is less than the dividend that's coming up tomorrow are the ones that are going to be at risk of assignment. So if you have a short call that has a strike price where its extrinsic value is less than 50 cents in this case, that call is going to be at risk. Now, it doesn't mean that necessarily it's going to be assigned, although the ones that have, so the deeper in the money that they are, the more sure you are to be assigned. So these ones might be borderline assigned, but these ones are going to be for sure assigned. So if you have anything in this area, you're going to be assigned for sure. So there's two things that we're going to look at here. Number one, we're going to take a look at the extrinsic value of your call. So we can see that the extrinsic value peaks at the money, and then it starts going down as you go further and further out of the money or in the money. So you can see that because we have a 50-cent dividend coming up, you can see that the ones that are at risk would be strikes such as the 59, for example, has 37 cents, the 58.5 has 21 cents, and so on. So anything from this point and lower are going to be at risk. Now, remember, the extrinsic value is not the only consideration. We have to take a look at the value, which is going to be all extrinsic of the corresponding put, because these puts are out of the money. They're only made up of extrinsic value, and the ones where the value of the put, so the extrinsic value, which is all the value they have, is less than 50 cents, these ones are going to be the ones that for sure are going to be assigned. Why? Because if let's assume that you are the option holder. If you have a call that has an extrinsic value of less than 50 cents, it's a good thing for you. It would be a good thing for you to exercise because you're going to capture the dividend and you're not going to suffer through the price drop, or you will, but you're going to capture the dividend. So that's going to make up for it. And remember, when you exercise, the value that you're giving up is the extrinsic value of your option. Since this is very little, less than the upcoming dividend, you're okay giving that up. But also, if you really want to be technically hedged and protected, you have to not only convert your long option, your long call, to long stock by exercising, but you also have to protect yourself on the downside. Because what will happen if, for example, yes, you let's take a look at this one, for example. The 59 has 32 cents in extrinsic. So you can say, okay, I'm going to exercise because the extrinsic value that I'm going to give up is only 32 cents and I'm going to be getting 50 cents. Well, yeah, but what happens if you just convert it to stock, you pick up the dividend, you get it into your account, but then you don't know what's going to happen. What happens if by the time you open, it opens at $52? Then, yes, you picked up the dividend, which you were not going to do if you had stayed with the call. But at the same time, you lost in the stock because you were not protected on the downside. Now, when you had the call, you can only lose the value that you have here. So, for example, you're only risking, if we take a look at the 59, for example, you're only risking 172 to 189. This is the value that it currently has. This is the most you can lose. But once you convert to stock, you're completely exposed on the downside. So it can go from 59 down to 50, down to 30. There is nothing stopping. Yes, the stock is going to drop by the amount of the dividend, but that's the regular price movement is not affected by the dividend. So it might drop. You don't know about that. Maybe they announce some bad results, or they give a warning about their upcoming results. We don't know about that. If you just convert the long call that you had, you're not only going to be giving up the extrinsic value of your option, the time value, but you're going to be converting it to stock, and then you're going to be risking everything all the way to zero. So if, let's say, you convert your long call to stock, and then the stock opens at 30, then you're going to be losing because you are going to be buying at 58.5, but you're going to be suffering through the stock drop. So you're going to be suffering a loss of $28 here. So it doesn't matter that you picked up 50 cents on the dividend, you're going to be exposed. So what you have to do is you have to hedge, and synthetically you have to recreate the position that you had before, so you're not exposed on the downside. So in order to do this, what you have to do is not only convert your long call to stock, but you also have to buy the corresponding put, so you're protected on the downside, and so that stock plus put is synthetically equivalent to a long call. So you're recreating what you had before, but you're picking up the dividend. So in order to do that, what you need to do is you need to make sure that the put that you're going to have to buy is less than the dividend that you're going to pick up. So let's say, for example, this 57. So if you convert the 57 to stock, your long the 57 call, you're converting the 57 to stock. At that point, you have the stock, you have to buy the put. So you pay 35 cents here. And now you have the same position. You used to have a call, the 57 call. Now you have the stock plus the put, which is equivalent, is synthetically the same position. So, but the difference is that you're going to pay 36 cents for the put. And now that you have the stock, you're going to be receiving the dividend, which is going to cover the put and have some profit on top of that. If you didn't do that and you had the long 57 call, what's going to happen is you're not going to get the dividend. Tomorrow, the stock is going to drop, and the price of your stock, the price of the call, is going to be affected because the stock is going to drop by the amount of the dividend. So In conclusion here, what you can see is that any strike price that has a corresponding put that has a value of less than the dividend. So in this case, for example, the 57, 57 and a half even, 56 and a half, 56, 55, etc. All of these are going to be exercised, and if you are short the call, you're going to be assigned pretty much for sure. So you have to be careful here. And what I would do now, these ones could be assigned as well, the 59, 59 and a half, but that would mean actually not the 59 and a half because it has 57 cents, but the 59, 58 and a half, these ones have less extrinsic than the upcoming dividend, but anyone exercising this is going to have to bear the risk of it going down, so be exposed on the downside, because if they were to buy the put, they're going to be at a loss, because now they're going to pay 81 cents to receive 50. So that might not be something that they might want to do. But the ones that are less than the ones where the corresponding put is less than the amount that we're analyzing for the dividend that's coming up, those ones are gonna be they're gonna be exercised, and they're gonna be assigned if you're short, almost for sure. So as you can see, rule of thumb, just your in the money calls are going to be at risk. That's all the risk you have if you have short options, and you have to look at the corresponding put. If the put is less than the amount of the dividend, then those are going to be assigned. So what to do against this, what to do to protect yourself from this? Well, one of the things you can do is, for example, if you're short the 57 call, which is clearly at risk here because of the 39 cents here, 32.39. So if you're short the 57 call, one of the things you can do is just roll it out in time. If you're okay with your position, one of the things you can do is you can close it so that you don't have to, because remember, when you're assigned, you're going to be assigned a short position. So when you're, if you're not covered, if you have calls that are short and you don't have the stock, if you have the stock, then you're going to lose it. It's going to be called away from you. So you're not going to get the dividend. But if you are not covering your short call with shares, then you're going to be short the stock. And if you're short the stock, you're going to have to pay out the dividend. So it's going to be something that's going to be going from you to the stockholder, to the new stockholder. So be careful here, because if you are assigned, not only are you going to go through a change in the makeup of your portfolio, but also you're going to have to pay out the dividend. So instead of having a short call, you're going to have short stock, and you're going to have to pay out the dividend. So it's a pretty big change. So if you take a look here, now what can you do? Okay, so you can take the 57, for example, which has a corresponding put value of 32 to 39. So this one's at risk. You take that one, and if you really want to keep that position, you can always close it. But if you really want to keep that position, you can roll it. So you can buy this back. For example, in this case, let's do it. We're going to buy the 57 because you're short, right? So you're closing it, and you're going to reopen it somewhere else. So let's say instead of 3 days to go, now you go to 24 days to go. So now you're going to sell this one. So what you're going to be doing here is you're going to be buying back your 3 days to go, and you're going to be selling it again at a later expiration, and for that you're going to get some credit. But more importantly than that, if you look at the 57, which is the same one but in a later expiration, now you're talking about an extrinsic value that's quite juicy here. That's pretty big. So now the corresponding put is about $2. So here you're absolutely not at risk, and you're not going to be assigned. So this is how you avoid the problem of an impending dividend payout on short calls that are in the money and that are deep in the money, and that have very little extrinsic value. So that's what I would do. I would, if I feel that the positions run its course, or you're already sitting on some profits on it, you might want to close it. But if not, just roll it. Just get it out of harm's way and take the 3 days to expiration, convert it into 24 days to expiration, gain a lot of extrinsic value, and at that point you're gonna be safe. Okay, so this is basically what it is. So just to summarize, so that you guys don't get lost. So to sum up, there's a dividend coming up for a stock where you have short calls on it, and they are in the money, and they're somewhat deep in the money, not close to at the money. What you have to do is, the safest way would be to take a look at the corresponding value for the puts. And once you know the dividend that's coming up, take a look at the strikes for the puts, and anything that's less than the value of the dividend is going to be exercised and assigned to you pretty much for sure. So for example, this one, 50 cents. So my line would be just around here. These ones are going to be exercised and assigned to you for sure. And once they're assigned to you, you're going to have to pay out the dividend because you're going to be short the stock. Or if you had the long stock, you're going to lose it. So either way, you lose. Now, the ones where the extrinsic value is less than the upcoming dividend, but the put itself is expensive. So for example, the 59 is 35 cents of extrinsic, less than the 50 cents, but the 59 is going to be 74.88. So this is more than the dividend that's coming up. So those ones might be exercised, might not be exercised. Maybe some market maker already has some puts from some other time, or their book already has the negative deltas that they need, and they might exercise anyway. So these ones would be at risk as well. I would also be looking at pushing those out of the way. So pushing those out of harm's way. So I would also, if I have this one, I would also take that one and either close it or just roll it out to an expiration where the same strike, if you want to stay there, has a lot of extrinsic value, and where the corresponding put is certainly higher than the dividend that's coming up. Now, this won't only happen for the front expiration. This can also happen for some other expirations, but of course, because the longer expiration that you're analyzing, the more time value those options are going to have. So the number of strikes that are going to be at risk are going to be less. So if we open up the 10 days, for example, here, 60.5. So which puts are at risk here? So which corresponding puts? So which ones would be here? So for example, this one, the mid is 43 cents, 46, 49. Okay, so just around the 54.5 and lower, those are the ones that are going to be at risk. So if you notice, it's not 57 anymore, it's 54. So the number of strikes that are at risk is less. And that's going to happen as you move further in time. So for example, this one, it's only this, so this is 17 days to go. So for this one, it's only the 45 strikes and lower. So by the time you hit 24 days, for example, it's only the 47.5 and lower. And if you go really far, like June, for example, in this case, 59 days to go, this is going to be only the 40 and lower. So it's only really a problem if you have either very deep in the money calls, or if the expiration is very close. So your expiration is very close to the current day. So those are the ones that you have to be careful. Okay, so this is pretty much all there is to know about the dividends. So you have to act. So you have to constantly monitor your positions. Otherwise, you might be in trouble here. So just make sure you don't have deep in the money calls or any type of in the money call where it's an American style option, which is actually pretty much all of the stocks, all of the regular equity stocks are American, so they can be exercised anytime before expiration. Those are the ones that are risk, and especially the ones that have large dividends coming up. Now, be careful too, because usually, so for companies, they have dividends paid out quarterly, so every 3 months. But some ETFs, for example, I'm going to take a look at Diamonds, which is the Dow Jones. The frequency here is monthly. So you have to, if you start having in the money calls, you have to be careful here, because even though the dividend is really, really small, so it's only the very deep in the money calls that are going to be at risk, but it's every month. So you have to watch out for this, because like I said, if you have short calls and you don't have the shares, you're going to get short the stock, and either you might either have a capital problem where you're going to get a margin call, or you're going to be closed out by your broker, or you're going to have a position that you didn't want. So you were fine being short calls, but you don't want to have short stock, and especially you don't want to pay out the dividend. So this is basically the risk that exists with dividends. So everything that I just said applies to long call holders as well. So if you're the counterpart to what I just said, and you have you're long these calls, well, you're better off exercising and picking up the dividend, and then at the same time buying the put, so that you're protected on the downside. So because otherwise you might say, okay, yeah, I don't want the extra money, I'm fine with my position. Well, yes, but you're gonna lose money. So it's not really a matter of wanting to make some extra money, but it's a matter of not losing the money, because the day after, so tomorrow, CVS is going to open for trading at 50 cents lower than where it was going to open. So if it was going to open at 60.43, now it's going to open at 59.93, because the market is going to discount the dividend that was just paid out. So that's going to affect your long call, whether you want it or not. So just to avoid losing money, what you might want to do is just exercise it. This is the one time where it makes sense to exercise before expiration. You exercise, buy the put, pick up the dividend, and if you want the day after, if you're fine with it and you want to recreate what you had before, sell the put out and sell the stock out and buy the call back. It's just the ex-dividend date that you have to be careful so that you don't lose money on the dividend payout, because remember, call and in general, option holders don't get dividends. Special or regular dividends, they don't get any kind of dividend.